The big picture is a major contradiction. Equity exposure is maxed out, but fear is also extreme. That creates a choppy, uncertain market. Here's the posture for the next 1 to 3 months.
Let's start with the hard data. Fund manager cash is down to 3.8%. That's a 12-year low. What does it mean? Institutions are all in. There's virtually no cash left on the sidelines to buy dips.
And here's that contradiction in plain sight. Markets are pushing all-time highs, but sentiment indicators, they're screaming extreme fear. Price is telling you one story, and the underlying mood is telling you the complete opposite. That's the core tension we have to navigate.
So what's causing this? Well, the first driver is top-down, geopolitics and policy. These are the big currents moving underneath the surface, pushing everything around.
This quote really gets to the heart of the strategy. This isn't about random tariffs. It's a deliberate industrial policy. The goal is to force critical industries, think semis, pharma, back onshore, and that creates a very powerful multi-year tailwind for certain domestic companies.
All right, let's look at the calendar. These are the known catalysts coming up. We've got the HOND SPAC vote. That's more of a micro event. But then, Friday at 8:30 a.m. Eastern, we get the rescheduled CPI data, a huge macro input for the Fed. Then, November 5th, the Supreme Court hears arguments on tariff authority. This is a big one. It could either validate or completely upend the current trade strategy. And finally, Datavault's earnings on the 14th will be a real test for the high-flying speculative names.
Okay, so that's the external stuff. Now let's look at the second driver, which is the market's internal plumbing. This is why we're seeing this weird stability and why every single dip seems to get bought.
The key concept here is positive gamma exposure. All you really need to know is this. It puts options dealers in a position where they have to act as market stabilizers. The market sells off, they have to buy. The market rallies, they have to sell. This is the mechanism that's been suppressing volatility and reinforcing that buy-the-dip behavior we've all been seeing.
You can see the effect of that gamma right here on the VIX chart. Look at the pattern. Volatility spikes up toward 22, maybe 23, and then bam, it gets sold off aggressively. It just can't seem to hold above that key 20 level. That's the positive gamma regime at work, right there in the data.
So when you see a pattern this predictable, it begs the question, how were traders actually playing this? How are they positioning for this repeated VIX slapdown?
Well, here's one answer, with conviction. This number represents a single trade. 10,000 VXX put options bought by one entity. It was a massive bet that this pattern of volatility getting crushed would continue. And it worked.
Okay, let's bring this down from the 30,000-foot view to the ground level. How do these big macro drivers actually translate into specific sectors and stocks? Let's look at the battlegrounds.
So here's a quick breakdown. Each of these speculative themes is a direct consequence of the drivers we just talked about. The US-China tech rivalry, that's fueling the quantum computing names. The push for supply chain reshoring, that's the engine behind domestic lithium and rare earths. US industrial policy, that's boosting nuclear. And then you have pure speculation, like the AI story in Datavault, attracting a lot of retail attention.
All right, so let's put this all together into a practical framework. We need to identify the exact triggers, the specific events or price levels that will tell us if this market is about to break out of its range, up or down.
The triggers are pretty clear and binary. On the bull side, the S&P has to hold 5550 support. We need a favorable ruling from the Supreme Court on November 5th, and the VIX needs to break and hold below 1850. The bear triggers are basically the mirror image. SPY breaks below 5550, we get an unfavorable court ruling, or that CPI data on Friday comes in hot and spooks the market.
Now for the bear case, it's not just about a price break. It's a sequence of events. Step 1 is the trigger, a decisive break below that 5550 support level. But that's not enough. Step 2 is the confirmation. We see the market's gamma exposure flip from positive to negative. And that leads to step 3, the response. Dealers switch from being stabilizers to being accelerants. They're forced to sell into weakness, and that's how a small dip can turn into a waterfall.
Okay, that brings us to how we can actually posture for this. Given the drivers and these potential scenarios, what's a risk-aware way to approach?
First, the mandatory disclaimer. This is for educational purposes only. It is aggregated analysis for your own research and is not financial advice.
The bull case is simple. We get favorable policy outcomes, which solidifies this whole pro-domestic framework. That brings capital flowing back into the U.S., driving a kind of manufacturing renaissance. At the same time, the market's internal structure, that positive gamma, remains stable and continues to absorb any sell-offs, allowing us to grind through resistance.
The bear thesis is the other side of that coin. It starts with a policy shock, a bad court ruling or a hot CPI print. That sparks a risk-off move, breaking that critical 55.50 support level and triggering the negative gamma flip. And because cash levels are so low, there's no one there to catch the falling knife. The high equity exposure means a small sell-off can accelerate into a rapid unwind.
Okay, let's look at 3 specific setups based on this. First, ABAT. Thesis is a policy overreaction. Structure, a long-dated call. The edge is a potential government pivot to larger financing than the market expects. Risk, they fail to get new funds. Max loss is the premium paid. Second, VXX. Thesis is a continuation of the volatility fade. Structure, a long put. The edge is the clear pattern of VIX rejection above 20. Risk is a real geopolitical shock that causes a sustained spike. Max loss is the premium paid. Third, TSLA. Thesis is a range breakout. Structure is a call debit spread. Edge is consolidation near the 50-day EMA and gamma suggesting upside. Risk is the breakout fails, max loss is the net debit paid, but be aware of assignment risk on the short leg.
So this all comes down to one core question. We have this strong internal market stability that's held things together for months, but it's about to run headfirst into a series of major external shocks. Is that internal structure strong enough to absorb what's coming?
Remember, this is not trading advice. Markets carry risk. Always trade your plan, manage your downside, and verify the data for yourself.
One next video.